hours ahead of the ECB data, 11 hours ahead of the ECB announcement, the knowledge of what's happening here is at least starting to form our opinions about what the ECB is going to do this afternoon. 50 basis points, hawkish tones. And sure enough, since then, of course, we got 50 basis points. And I can't say they've been hawkish tones. I think they've been kind of hawkish neutral. And the equities have been quite happy to balance against that hawkish neutral tone on the basis that there's been other constructive pieces of information from the likes of Credit Suisse, Swiss National Bank. So there's been some constructive tones from those types of things, allowing equity buyers to still be involved in this lower price. So you can see that they've actually been buying right off the dealer's level. So they're doing the opposite to what they did yesterday, right? They were selling off the dealer's level here. The dealer's level dropped a little bit, and now they're buying off the dealer's level. So what they're going to try and do is obviously try and rotate this back through the maximum gain price, which realistically isn't really the maximum gain, but that's what we're calling it because it's the cash close price. The maximum gain is actually, you know, if most of the business was done during this day, it's the POC of the entire day, right? The maximum gain price is the POC of the entire day. That's where the most volume's traded. So therefore, that's where most of the options are traded. So we know that's normal for the maximum gain area each day, but it is, you know, we'll still use the cash close as the main red zone, green zone level. And that's why we call it our maximum gain price. It's not actually the maximum gain, but you get the basic thrust of the argument. And obviously, when we can see if the dealers can hold on to this price, they could be in good shape. They've managed to rotate it high enough and close enough that they can almost lock in 100%, right? If they've sold this price here, if they've gone net short against these other sale orders in the background here, then of course they pretty much have maxed out their whole entire day. Perfect. Dealers can't lose money today. That's 100% certain. They cannot lose money. This day, they could have lost a lot of money, but they were able to hold the price and bring it back into their straddle level to get flat. And because of that, they were able to hold the play. Remember what we said yesterday, that if they can find a bottom edge, for example, this bottom edge here, and if they decide to buy and unwind that bottom edge, you might be able to find that they could make all that money back. Well, there it is right there, isn't it? They did exactly that process. They bought the bottom edge in the evening session. They managed to pull the price back round, made a great trading decision into that low price. Absolutely fantastic little trade. If they did it. Any evidence that they did do it? Well, if you look at the VIX 9-day narrative, you can see there's definitely some evidence of buying at low prices, that's for sure. But is it confirmed by the rotation in the products? Not really. You can see the products initially still seemed really bearish. But take a look at the very low price, Paul. Take a look at the very low price. What happened at the very lowest price? Do you see that they started to roll the volatility out? You see that? So at the very, very lowest price, they started to find the opportunity to bid back into that as a play. And obviously, they've taken it beautifully back up. Now, it's time to roll back out again, so they might just have banked their monies at that stage and says, we've made enough. Let's clear our books here. Fair enough, but obviously, they've came back in hard here to take it back up to the next line, haven't they? And then as we get into today's market, you can see it's not the most constructive, but it's certainly not the most destructive either. You know, it's not as bullish as they would possibly have liked to see. It's not that bearish either. So they've still got the opportunity to keep working the buys off the lows. But obviously it's touch and go as to whether they're comfortable or not, because we've obviously got that macro narrative in the background. So crazy good, crazy whatever you like it to be, is what it is. Buy-side bonds have done really well, so that's been a nice play for us. We've been almost exclusively buy-side bonds in terms of the curve shapes and things like that. We had a lot of buying opportunities in the early morning session. I'll take this one off so we can see the black line isolated now. As you can see, the black line giving us the opportunity to trade a lot of grail type stuff in here. And we're forecasting, obviously, some bond buying opportunities to come in behind that trade. You know, we're obviously thinking that we're going to start seeing some of this idea here. So we're looking at lower rates. Lower rates means long bonds. Long bonds have resulted in a fairly substantial buy side pop off those low edges for over $2,500 per contract, which is pretty good. Short oil is getting absolutely pressed and pressed and pressed and pressed here at the moment, guys. Not crazy surprising, I don't suppose. We talked about the Russians yesterday. We talked about the fact that their supply lines were starting to clog up with oil, and the demand just wasn't there, was it? Nobody's decided to talk it up. No. And interestingly enough, when we look at those supply lines, you can see that the shape of the commodity risk line is also very bearish, suggesting supply as well, right? So when you look at copper gold, you're looking at the supply demand line for the metals markets, basically, in terms of industrial. Well, that's obviously a very good indication of this oil line, isn't it? Very good indication of this oil line as well. So that's a nice, easy to read piece of information right in front of your very eyes. Now, what else was incredibly obvious? This line right here. What is this line right? Let's take a look. Let's go back into the slightly bigger picture and see if there was any clues about oil price sell-off, guys. Was there any clues? Well, if we look in the background and we look at the supply coming in, it all started here on the 6th of March, didn't it? It started on the 6th of March when Goldman started to sell inflation, when the supply line started to get sell side only. Remember this, Simon? Remember Goldman said that they were going to do $100 oil, and the very next day the direct dealers went short inflation. We chatted about it in the room actually the very next day, didn't we? Goldman's went long oil, but the very next day they seemed to be selling inflation, and you said, what the hell was that all about? Well, if you remember that conversation, oil was trading into the high 70s and 80s, right? High 70s and 80s. It's now trading into the mid 60s. Mid 60s. $15,000 a contract lower in just 10 days or so, guys. 15 grand per contract in just 10 days. That's kind of crazy. But we like it a little bit of crazy, but not that crazy. Well, the thing that didn't happen there, Subra, was the carry. Did you see that the carry never even moved on all of that chatter and all of the ECB there? Did you notice that? Carry never moved. So you can see from the announcement here. Oh, remember we had this big buy target for the pound, but that was superseded because we'd already closed out our sterling trades. But remember, we were talking about the possibility of going net long into this position. Well, obviously, if they had started to ease off on the bets, I mean, the 50 basis point by the ECB was only a 50-50 shout, right? So the fact that they did 50, you'd imagine that the carry would have given us a little bit more of an upside pop. Well, the carry hardly gave us any upside pop. The red line is the German carry against the US. And you can see the carry actually over the course of the whole day is still actually down, not up. The carry over the whole day is actually still down. So you'd have imagined A lot of people got jammed on long euro positions into the high prices, and they've been absolutely stung rotten by that position, right? They've been very aggressive. Look, the carry trade must be getting better. The trajectory seems to be completely different. The Germans seem to be, the Eurozone seems to be positive. For interest rate hikes. The Americans are now rolling back 425s. They're rolling back 100 basis points. That should end up causing the carry to really, really adjust in favor of the Eurozone, and the euro dollar should go through the roof. And yet we find ourselves with buyers of euros getting trapped at the top edges because the carry trade actually never made a single step forward. Didn't adjust a single step. Yeah. So you might be saying, so basically, it looks like, well, I mean, we say Goldman's because we're talking about a line, aren't we? It's not actually Goldman's, but it could be Goldman's. I mean, it's obviously, it was Goldman's quote about the $100, and yet Goldman's is one of the big direct dealer players. So you'd imagine they've said one thing and they've done exactly the opposite. Yeah, it does make sense, Miguel, doesn't it? They've said one thing and they've done exactly the opposite, because otherwise, why the hell was the inflation break-evens getting hammered when they're calling out $100 oil? It's almost the same as the UBS call, remember? It seemed as if UBS were calling out that higher oil price, and at the same time, UBS sellers were in the market selling oil into that call. Does everybody remember that? We actually tweeted that one as well, didn't we? Anybody remembers the tweet? We sent out a tweet and we says UBS are at it again. Remember that comment? UBS were talking about $125 oil, remember? And we says, well, that's not what's showing up in the actions. The actions seem to be bearish. So it looks as if UBS are at it. They're calling the price up. They're calling the price up, but they're actually selling oil into their call. They're selling oil into their call, yeah. So crazy stuff. Crazy stuff, guys. Crazy stuff. Okay, so let's see the truth of the ECB, guys. Let's take a look at the truth. Of the ECB. Is the ECB on a different trajectory from the Americans? Yes or no? So it seems by what they're saying as if they are on a different trajectory, right? It seems as if they're on a different trajectory based on the last comments. It seems ECB are still on the positive rates, still very, very definitely positive, whilst the Americans are very definitely negative. So we've got this idea that they're going in opposite directions. But the reality, again, is slightly different. This comes back to Sam's question from yesterday. Is Sam in the room? So Sam asked the question yesterday. What was Sam's question yesterday? Is there any way of being able to recognize what the ECB is basically going to be doing, the same way as we can recognize what the Fed's going to be doing? And the answer is not directly the same, but pretty close. In the German markets, we do have access to the 1 month and the 1 year yields and the 3 month yields and the 6 month yields, just like every other market, right? So we could just construct a very short term rate curve, right? We can construct a very short term rate curve. So if we look at German 3 month yields, is German 3 month yields very bullish? This is a daily chart, guys, daily chart. If we look at German 6 month yields, are German 6 month yields very bearish, bullish? Very bearish, very bullish. If we look at German one-year yields, very bullish or very bearish. You can see actually German one-year yields inverted against the 6-year. Do you see 6-month? Do you see that? So we can see that the German 6-month inverted with the 1 year, suggesting interest rate cuts in Germany with an inversion, right? So that roll down is a problem child for German banks, correct? For people who are owning German bonds, that roll down the curve is obviously problematic at that stage as soon as you go inverted. If we look at the 1 month to 1 year curve, you would imagine, of course, that we'd be seeing a flattener, wouldn't you? Well, we've actually been seeing a German flattener for some time. Look, this is 1 month to 1 year. It doesn't quite go inverted because the inversion is at 0, right? So that's the 1 month, 1 year. Okay. So if we go back to that other question that we were asking earlier, what happened to this 6-month? What happened to the 6-month, 3-month? So let's just find out what happened to the 6-month, 3-month. DE, 6-month yield, yeah, minus DE, 3-month yield. And let's put that on the charts and let's normalize that to the right-hand scale as well. And let's change that to normal, regular. And what happened to that trade as well? What happened to that trade? Again, very, very, very negative. In fact, we actually had a complete inversion. I don't know why it didn't catch that inversion there. Oh no, I've done that against the 1 year. Sorry, I've done the 1 year against the 6-month. My mistake, guys. 1 year against 6-month. That's why it didn't invert. Okay, fair enough. So if we do 3-month against 1 year, let's just see if that gives us that inversion that we were looking at. So the 3-month 1 year still doesn't invert, but the 6-month 1 year did. It is what it is. It's good. It's close enough for what we're talking about here. But you can see what's happening to the German markets. We're actually almost getting to inversion as well, aren't we? We're almost getting to inversion. So the idea that Germany is doing something completely different from America just isn't true. It's almost identical. It is literally almost identical. So take it as you see it. You know, this is obviously just the German chart. You could obviously overlay this with the US chart if you want to see what's happening in the US markets. If you want to do a comparison between the US 3-month and the German 3-month, you can do exactly that study, can't you? So you can do the US 3-month yield, or sorry, we did the 1 year first. The US 1 year yield, and we can take that US. Yeah, so you can obviously do these little exercises just to compare one with the other. And you can obviously look to see whether there's any difference between them so that you can see the trajectory of a certain period in the curve, right? So if we take off the German yields and we just use the trajectory, can you see the difference between the Americans and the Germans? Well, the Americans have gone negative hard here, right? But we know that because we covered it in classroom a few days ago. We talked about the reason why there was serious problems because the front end of the curve is now very, very, very definitely on the sink through, right? But you can see that they are doing the same things pretty much the entire time, right? You know, when you look at the shape, you can see America leads the trajectory here of the Germans, and then the Germans catch up here. And then you can see that the Americans then started the charge to the downside here, which meant that this top line carry here was always destined to be tumbling towards the 0 point. And that's exactly what's happened, hasn't it? So you can see that the Germans lag behind the Americans. And that's that old expression you've seen many times in the past about America sneezes and everybody else catches a cold, yeah? But you don't catch a cold straight away. You catch a cold a few months down the line. You catch a cold a few months down the line as the markets start to tie up and as the cash changes, as the interest rates change, it starts to tie up the systems. And obviously, you can see that there is very little difference between these two markets. Does that make sense to everybody, guys? Is that pretty straightforward? Now, one of the questions that you might have, what would be the main question you would have from an exercise like this?